So a couple of things at play. I mean, I think people realize the last few years we've lived in this extraordinary world of liquidity. Central banks are putting liquidity in the system in extraordinary size. The ECB, the Bank of Japan, the Fed. Now we're coming off, and so everybody knows when you exit quantitative easing and when the economy improves, you slowly start to move your way out. However, the delta, what happens is where we are today versus where we were a year ago, 2 years ago, is really different. It's why you see the volatility in some of these markets. But there's something really important. It's not just as the ECB ending QE, not only is the Fed exiting QE, the U.S. Treasury is issuing $1 trillion net supply. That drains liquidity from the system. When you raise short-term interest rates and the Treasury issues debt to fund the stimulus, we're putting a tremendous amount of debt into the markets, which has to be absorbed. So what's happening is that creates a crowding out dynamic that's really powerful. Just this week alone, I was, this is what I do every week. I look at it and I say, what is the Treasury supply this week? We got another $108 billion, 2-year notes, 5-year notes, 7-year notes. It's a lot of debt. So you've got markets that are going to be more volatile going forward.
We keep trying to figure out what's happening. Are there sellers in this market? But you make it sound like it's not necessarily the big problem that there are sellers, just that there's a lot more supply and you don't have the banks buying that were before. So,
by the way, not only do you have supply of treasuries, the banks are buying, but not nearly as much. If you think about the way we funded debt over the last few years, a lot of it went internationally. A lot of it went to China. A lot of it went to Japan. Mm-hmm. It's very, very mixed net selling coming out of the international. So you've got to digest all the supply domestically. And by the way, we will, but you push front-end interest rates higher. When you push front-end interest rates higher, you see this. You see this in flows across the industry. Gosh, you know what? I'll sit in a 2-year note. The 2-year note gets me 3%. I don't have to take credit risk, equity risk, interest rate, yield curve risk. 3%. Life is good.
And who wants 50 basis points in Germany? I mean,
So there's a really interesting dynamic. I agree with that. However, if you're sitting in Japan, you've got to hedge the currency.
I know.
Yeah, ironically, actually, bunds are more attractive for Japan because they got to hedge the currency risk of treasuries, which is a funky dynamic today.
Well,
but you're right.
That the players in Europe who have to buy European bonds are forced into situations.
That's exactly right. That's exactly right. Anyway, you just have a dynamic that creates more volatility.
So I love this theory and this insight that you have to it because it kind of explains a lot that we've been talking about over the last couple of weeks. We have this fight in the markets where you have the big banks who can say, look, consumers strong. I look at the credit cards, I look at the mortgages we're issuing, I look at what we're issuing in terms of big lending to corporations. It all looks great. But you have people who watch the markets very closely concerned. And maybe this explains exactly what they're seeing.
So, if you look at there are parts of the economy that are not interest rate sensitive. So the way commerce works today, it's different than in the past where basically the whole economy was interest rate sensitive. Now you have technology, you have other industries that aren't interest rate sensitive. But if you take the industries that are interest rate sensitive, housing, I mean, you've talked about on the show, you look at housing starts, existing home sales, mortgage applications, they're really soft. You look at loan rates for autos now. Why are auto stocks coming under pressure? There's a variety of reasons, but that's one of them. You look at small business lending that's coming off. The interest rate sensitive parts of the economy are starting to show real pressure. The home builder ETF is down 30% from the highs. I think you have a dynamic to part of why I think the Fed is going to pause. I think you'll go in December and then I think you're going to pause. Is we've moved rates up. If you get a mortgage rate that hits 5%, you're talking about tangible tightening now. I think the Fed is going to pause. And if you don't, this uncertainty about where is the neutral rate and where do we have to go, that's what markets hate, uncertainty.
And that's the last part of this that I think we really need to emphasize. If anybody wasn't paying attention to what you just said, you hear all of this and you think it's time to put on your bear hat, but your thesis is you can stop short of that because you think the Fed will pause.
Listen, the Fed is, everybody's focused on, and quite frankly, I thought some of the communication, we're not sure where the neutral rate is and we may have to go beyond that. Markets can't stand uncertainty. Give me a number. Even if the number is a bit tighter, just give me the number. I don't know how far you're going to go. There's one overriding. Well, so there's one overriding, which is exactly right. I think there's one overriding concept. The Fed reacts to the data. The data is showing you something that is different than it was 6 months ago, a year ago, year and a half ago. As you get into next year, by the way, you look at your CEO confidence survey, you're starting to see it bend down. By the way, the number that I thought was mind-blowing last week, the University of Michigan inflation expectations, 5 to 10 year, hit the lowest level it's hit literally since they've been doing that. How can inflationary expectations be the lowest?
That's consumer confidence reading.
Totally. Yeah. But particularly the inflation component thereof, meaning the Fed will react to the data, and if the Fed reacts to the data will tell them something different.